Welcome to the Clear to Close podcast with your host, local mortgage expert Ryan Bolton. Ryan has the questions and answers, tips and tricks, do's and don'ts, and expert guests to explain all the steps needed to buy or sell real estate. And now it's time for the Clear to Close podcast.
Hey everyone, Ryan here. I am a mortgage nerd. Welcome to the Clear to Close podcast, where our goal is to help you with your mortgage and real estate needs. And I really enjoy doing this, put these together. And I get a lot of questions about interest rates, mortgage interest rates. So I thought it'd be important to kind of break down what that means, some of those terms, and what factors into your interest rates. So let's start with our first slide today and kind of break down today's topic. What we're going to talk about is what are mortgage rates. Then we're going to talk about the factors that affect your interest rate, and then some of the market factors that determine your interest rate. So these are some of the topics that I get the most, and it's in the news more often as the Fed starts talking about interest rates, those types of things. So let's just dive right into what this topic's all about. So let's go to slide number 2. And the first one I want to talk about is what is interest rates? So mortgage is simply the term for a home loan. I can't tell you how many times people say, well, I don't want a mortgage. I just need a loan for my house, or I just need to buy a house. I need financing for the house. That's what a mortgage is. I'm not sure why that term can be so intimidating, but you'd be surprised how many times people say, oh, no, I don't want a mortgage. I don't want a mortgage. I just need a home loan. But really, it's the same thing. So you just like you wouldn't get a car loan to buy a house, and you wouldn't get a mortgage to buy a car. These are just simply the terms that are associated with the type of financing needed to purchase real estate. So it's a mortgage. Now, you have a couple of the terms that tie into mortgage. You'll hear the term first mortgage or second mortgage. These are simply the lien positions against the home. Most commonly, a first mortgage is used to purchase the home or refinance. That's the first lien against the property. Now, why that's important is if the loan goes bad, or you can't make your payments, or something happens, or you sell the home, that loan is the first one to get paid. So that's why it's always usually called a first mortgage. Where second mortgages are home equity lines of credit, or HELOCs. That's the abbreviation for home equity line of credit, or some other type of second mortgage is the second lien against a property. So that's some of the terminology of what type of mortgages are out there. And then when it comes to interest rate, that's simply the amount you're paying above for the money or money for the mortgage itself. So just like a car loan, you have the principal on the car loan, and as you pay it back with principal and interest, that's how the lender makes money on loaning all the money to you today and slowly getting it back with payments. Now, with a mortgage, it's usually amortized over a 30-year period. So you have a lot of interest on the front end of the loan, and then more and more gets converted to principal over time. But that interest is what you're paying to get access to the funds today. I mean, you're talking $300,000, $400,000, $500,000 today, and over time, you're paying that money back. So that's kind of the different types of interest rates that are out there. Next, you're going to have a fixed rate mortgage versus an adjustable rate mortgage. So most common is a fixed. This is where it's a 30-year term, 30-year payment, locked in the entire time you have the loan. But there's also a loan that's been kind of coming back in popularity. They're called adjustable rate mortgages. This is where they're fixed. The rate is fixed for a certain period of time. Most commonly is 5 years. Then after that has the ability to adjust. Now, years ago, if you remember, you heard about adjustable rate mortgages. The market's kind of gone away from them. Nobody really likes them. They've really come in and regulated these, so they're a lot safer, and they're designed to not move as much. They have different margins and things that adjust when they adjust. But they have becoming a little bit more popular because many people don't keep their homes 30 years. They may only keep it 5 to 7 years. So these adjustable rate mortgages are designed to kind of fit that need. But I'd still say a vast majority of mortgages are going to be a 30-year fixed rate mortgage. So let's go on to slide number 2. The most common, 3. Yep, there you go. Perfect. So the next thing I get all the time is, okay, what are the rates? What is today's mortgage rate? And it's really not just a simple answer, because there's a lot of factors that determine the rate you will actually get. Now, just like car loans, mortgage loans, payday loans, they're going to advertise some of their best interest rates to try to get people to call, to get enticed by a car loan or a lease or whatever it is. But you look at the small print, and it is a very small percentage of people get that base rate or that starting interest rate. Most of the time, there's going to be adjustments that are going to add to the rate or add to the cost. So I want to review some of the things that are the biggest hits to the interest rate that will determine the final interest rate that you actually get. The big one is going to be credit scores. Credit scores are like a report card on how you've made your payments over time. And most interest rates are based on a 20-point tier. So the rate for a 640 to 660 is one tier. Then if you go 660 to 680, you're in another tier, and so on and so forth. They're usually in these 20-point tiers. Now, when we pull credit for mortgages, we typically pull all three of the credit bureaus and use whatever credit score is in the middle of the three. So we don't add them together or average or take the high or the low, just whatever score could be in the middle. So if you have a 720, 719, and a 600, they'll still use that middle one. Now, there are some guidelines if it's too much of a difference between the scores, like in that scenario. They want to see, okay, well, obviously it's not reporting to the other two, so it is something where they may make adjustments if there's big differences between the scores. But generally, they're going to take the middle credit score. They're also going to take the middle credit score of all the borrowers, so husband and wife or brother and sister or a couple different people on the loan. Whoever has the lowest middle score will determine the tier of the interest rate. So you could have a spouse that has a 800 credit score, but then the other spouse has a 640 credit score. They're going to take the lower. They're going to take the higher risk of those credit scores to determine the interest rate. So a lot of times, as I'm sitting down with clients, we'll figure out, okay, what can we do with the credit if we're just below a tier? And I can't tell you how many times I've worked with a client for 30 days, 60 days, and got them from that 640 tier to the 660 or 680 tier, and so many things open up. Better interest rates, better programs, maybe less money down, cheaper interest rates, so your buying power can go up, or just guidelines can change a little bit. So maybe the debt ratio is a little high, and if the scores are higher, they offset that risk. So I'm telling you, credit is a huge factor on any type of financing, but especially a mortgage, because it's really the report card on how you've made your payments. But it's also incredibly easy, if you know why the score is, to get you up to one more tier. Now, once you get in the 720, 740 range, it gets harder. It takes more time. It definitely gets harder, but it's not that hard to go from a 620, 640, 640, 660, those types of tiers. It really is just a matter of knowing why the score is the way that it is. One quick tip that I give everybody is your credit card balances. They factor in your credit score more than almost anything else, and how you manage your limit and your balance can help your score the most. So I'm sitting down with a client, they have a lower score. The first thing I'm going to look at is their revolving accounts. If they got a $1,000 credit card and it's always at $1,000, their score is lower. But if they can get it under 30% of the limit, you can see a big jump into your credit score just within one cycle, within 30 days. So that's one of the best tips to kind of get you to the next tier is reviewing your revolving accounts. So credit's number one. And the sooner you start a pre-approval, the sooner you start working on your credit, the better programs just kick in. And I can help you with that, whether you're 6 months down the road or a year down the road. I've worked with a lot of clients on helping their credit because it can take time. And if you take the time, it's free, or freer, I should say, because you still have to have money to pay down the credit cards. But if you have to do rapid rescores or you have to do things to kind of update the credit report sooner instead of letting it kind of go through natural cycles, it can really add up the cost to get those things fixed. So the last thing you want to do is have your lease expiring next month and try to look at buying a house and have to put all that together within 30 days. You're just far better off to give yourself a little more time. Give yourself 90 days. Give yourself 60 days. I mean, it's amazing what we can do in those windows. So credit's a big factor. The next one is occupancy. How you're going to use the home is a big factor. Oh, stay on that other slide. Sorry. Had him jump. Freddie Mac's jumping ahead on me. So the next one is occupancy. This is how you intend to use the house. So think about it this way. If you're living in the home, you're more likely to make that payment. Your kids are living there, wife, spouse, day-to-day stuff, all your personal belongings are in that primary home, your primary residence. But if you have a rental home or a second home and you lose your job, or they trash the house, the renters don't take care of the house, or they start missing their payments and now you have to cover two mortgages, you're more likely to start defaulting on the other homes than your primary residence. Just historically, that's very true. And so investment properties, second homes that aren't primaries have a higher interest rate than your primary residence. and just totally makes sense. Now, you can change your occupancy. You can buy a house and turn it into a rental a couple of years down the road, and that's fine. It's not like you have to refinance to change the occupancy, but it is on the initial loan. When you first buy that piece of property, how you intend to use it at the beginning is what they're going to factor the interest rate on. And it just makes sense. Also, there's some loan programs that just don't even loan to investment properties, like most of the government-backed Fannie or FHA, VA, USDA, some of these loan programs that are federally backed, they don't even offer investment financing, investment property financing. So that's a big factor on what determines your interest rate. The next one is loan to value. This is the down payment you're putting on the home. So if you're borrowing 100% of what the home is worth, it will have a higher interest rate than if you put, say, 30% down on the same home. So that's another factor that determines the rate you will actually get. And that's probably the next biggest factor is how much money you're putting down. Now, there's times because of mortgage insurance that putting less down because of that extra insurance, the rate can be slightly better. So it's kind of a magic window. If you put 10% down, it's kind of a magic number because they still have skin in the game. They still have that down payment and they have mortgage insurance in case the loan goes bad or default or something like that. Where right at 20%, they don't, and say almost like they like to have even 25% or 30% down for the better rates to start kicking in again. So it's kind of these weird little tiers based on risk, based on protection, based on the security markets, things like that we'll talk about here in a moment, that really affect what type of interest rate you're going to get at the end. And then the last thing that really factors into your credit score or factors into the interest rate you're going to get is debt to income ratio. So the more debts that you have with the new mortgage payment versus your income will determine the type of loan that you're going to get. Now, people earn their income all kinds of different ways. The best rates are going to require 2-year tax returns, verifiable income, taxable income for self-employed. So not the top number, what you actually brought in, but the bottom number after your expenses. And so that number is what's going to determine, divided by your other debts, of what your debt ratio is going to look like. Typically, they want to be under 45% total. So 45% of your monthly income that's factored, and all the other debts, including the new mortgage payment, they want it under that number, usually 45%. Now, even 43, there's different tiers. When you get over 45, you'll see exceptions. You'll have to either have higher residual income left over, or you're going to have more money in the bank, more money down, higher credit scores to kind of offset the risk of a higher debt to income ratio. But there's certain programs like USDA are incredibly strict on debt ratio. You can't go 0.01% above their numbers, where I've seen approvals like VA loans, I've seen go up to 60% because they look also at what you have left over. So if you're making $30,000 a month and your debt ratio is 60%, well, look how much you have left over. So they kind of look at what's left over, what makes sense. But generally 45%, that's a number that we're really trying to be close to when we're doing pre-approvals or figuring out what loan program most likely will accept the scenario. So these factors are really big: credit score, occupancy, loan to value, and debt to income ratio. But there's a couple other factors that determine the overall interest rate. So these are what gets you kind of your rate specifically, but there's other things that determine the rate to even start with, like where does it even start? All of these things we just talked about are what they call hits or adjustments. Loan level price adjustments is kind of the technical term in the mortgage industry, but we usually call them hits to the base interest rate. And what will happen is it'll either be a hit directly to rate or to the fee for that rate. So for instance, let's say it's a 1-point hit, that's usually to the pricing of the interest rate. It's not like a full point to interest. It's not like you'll be at 6.5 and it jumps clear to 7.5. So it's based on the cost of that particular interest rate that you can either pay out of pocket or part of your down payment when you buy a house, or most people and how they do is build it into the rate. So the rate just goes up to offset these risks, these hits. It's really amazing how often mortgage rates are very similar to like homeowners insurance or car insurance or health insurance. They're looking at the likelihood of foreclosure, and they have a huge sample size. I mean, millions of mortgage loans that they can track and say, okay, which ones are defaulting? Why are they defaulting? What levels of risk are we willing to take on as a capital market or as a lender? And that's where the type of loan and the guidelines that we see are set based on the risk levels they're willing to tolerate. And some of them are also regulated by federal government saying, okay, these are some of the risks we don't feel you should take on at all. After the 2008 crisis, they stepped in and started defining what some of these things were, that if you're a lender and you were going to say you're doing qualified mortgages, you had to follow some of these guidelines. Otherwise, it wouldn't be in the safe harbor. It wouldn't be in a situation where you could even loan to that particular client. But you also have capital markets that are like, hey, we'll take on some additional risk. If they put more money down and have a higher credit score, maybe we won't need 2-year tax returns. Maybe we'll go off of 1. Or maybe we'll just go off of business bank statements and we can see, okay, they've got the cash flow going through here, but they've had some big write-offs in the past or depreciation or expenditures that they can take off of their gross income that isn't really a factor on their ability to repay the loan. So you're always going to have capital markets trying to fit a need and trying to fit a clientele as long as the risk levels match what they're trying to do. And it's all based on what we're trying to see here. But these are the factors that really factor into the rate you're going to get. But where's the start rate? Where does the kind of the rates actually start at? So let's go to the next slide. There's 3 major factors that determine what the base rate, kind of the starting rate's going to be. And more people are aware of this than probably I've ever seen in my career is inflation, the political landscape, and just all how inflation has hit our daily lives with how much it's gone up and all those types of things. That's really affecting the value of the dollars. Dollars aren't going as far, so interest rates are another way to offset that cost of money. It's also a way to slow down the creation of new money through loans. So many times these big mortgages are securitized by pooling together all of the money from these mortgages and loaning against that. So when you go to your bank and you deposit $100, they're able to re-loan that out as much as 10 more times. So they just created $1,000 to loan back out because they know that money's going to come in at an interest rate to pay down the original amount borrowed. Now, many markets, many banks are starting to cut back how much they can kind of leverage those deposits on future investments or future money coming in. But the Fed is really a big key in determining that kind of starting base interest rate that lenders or banks loan over and back and forth to each other. It really was designed to slow down the creation of new money through mortgages or cars or just loans itself by raising the expense of that money. And that was really the design of the Fed. One of their best tools to combat the loss of the dollar is raising the cost of that new money being created. So the Fed funds rate, or prime is what it's typically called, doesn't play directly into mortgage rates other than, say, home equity lines of credit or second mortgages. That's where you'll see that specific rate is played a little bit more because it's really an index. It's what is tied to that particular short-term money. But when it comes to long-term, 30-year fixed type money, it's still an indication of the overall cost of money. So Fed funds is very important, but there's other things that factor into the actual interest rate you're going to get. The next one is called secondary markets. So this is the ones that are buying up these securities. These are the ones that are pooling many loans together and purchasing them as a block for their investors. Because mortgage rates are still one of the safer investments out there because you can pool it over 100 mortgages that don't default all that often. They're very consistent on making the payment, especially if they're blocked together for, say, primary residences or FHA loans or certain types of loans that investors want because they are just so stable, a constant stream of income coming in each month. And so much of these loans at the front end are interest payments. There's not a ton of money going towards the principal, but there's still people that sell or refinance or do things that pull those monies out of those securities, but they'll block them together in hundreds and thousands of this one type of loan, a certain range, whatever they want to do, and they'll block them into these mortgage-backed securities. So MBS, or mortgage-backed securities, is really the biggest factor on determining what interest rate you're going to get. And when you hear bonds, most people know or maybe have heard of treasury bonds, which are these government-backed promises to pay. I mean, they're probably the sexiest security you can ever buy as a bond. But the mortgage-backed security bond is also something that's backed by actual payments coming in on all these mortgages. And that's where they are a little higher rate than you'll typically see on treasury bonds, but there still is some level that the bonds are going to break down or get paid off, or they'll be foreclosures or whatever that happens to be. But you're seeing a big demand for mortgage-backed securities because they are a little not quite as safe as a treasury in theory, but they're still a better rate of return than that. And the defaults on mortgages have been historically low, like crazy, crazy low, mostly because the rates on them were so low, and most people aren't defaulting because they either have equity in their home, so they don't have to just walk away from the house, or they can't replace that house payment with anything else in the market. So they're going to miss their car payment or other types of payments well before they're going to start missing mortgage payments, which throughout most of mortgage history, that's really been true. The 2008 crisis really just kind of broke that paradigm because for decades, centuries, as long as mortgages have been out, they've been really, really a safe investment because the likelihood of foreclosure is pretty low. But even then, even if it's a 10% of the portfolio, you still got 90% paying and the asset's still there to be sold and paid back, and there's still equity in a lot of the homes. So it is something where the mortgage-backed security market's been pretty stable, and the demand for it has been pretty hot as a safe place to put the money. And what you'll see is as the stock market's kind of going nuts, people want to jump on that bandwagon. Some people kind of move away from bonds. So then you'll see mortgage rates go up to entice that money back. But when there's uncertainty and things going on in the market, it typically jumps back to bonds. So you really have stocks or bonds, or what most of these people are putting their money into. And it just depends on kind of the ebb and flow of the market, which one's driving which one. But it's funny how often if the market's doing really well, that's usually bad news for interest rates. Kind of an opposite effect. When the market's doing bad, you usually see interest rates do better because they're pulling money from the riskier stocks or the riskier commodities markets or foreign markets, or trying to find a safe place to put the money to ride out the storm. And bam, the U.S. bond market is one of the biggest places that you'll see money flow to as one of the safest places to put the money. So with these mortgage-backed securities, again, they're blocked into these big blocks that are certain risk levels, and they'll get rated by rating companies on how that is rated. That's one of the big reasons for the 2008 collapse is they were rating stuff that was subprime, that wasn't the good mortgage-backed securities. They were rating them basically all the same because the way they were spreading out risk and the sense that, well, it's a mortgage. People aren't going to miss their payment. People aren't going to get upside down. Values always go up. Interest rates are locked in. These types of things really gave it a false sense that it could just be a paper all the time. And once the rating agencies were allowed to give it such a high rating or kept the rating a little bit artificially high, this is where certain hedge funds or retirements or pension accounts were able to invest into mortgage-backed securities. So it just kind of flooded that market with this extra money, and guidelines just got looser and looser to kind of fill that demand of the mortgage-backed security market. And you'll still see it today. There'll still be levels of risk that are done, but the rating has gotten far better, and it's still low. Even some of the subprime loans, because the way they've been structured, the risk on them has gone dramatically down, and the rate of return is going to be higher on a higher risk loan. So that's where you get the terms like Fannie Mae and Freddie Mac. These are the two biggest securitors of mortgage-backed securities. They create these big pools for investors to get return on this money, but they also set guidelines that they just don't do certain types of loans to minimize that risk. They're really known as the prime or conventional loans. Then you have Ginnie Mac, which is the mortgage-backed securities of government-backed loans that also have some additional insurances built into them. But these are the different types of loans that are going to be out there based on the client's need. But every one of them is going to have different interest rates, different start values, different hits, different things they're going to say yes and no to based on the client's credit or income type or occupancy, all of these factors. And that's really part of my job, is to get a client situation in and find out what loans they qualify. But everybody asks, what is the interest rate? There isn't just one interest rate. It really isn't. It doesn't work that way because there's so many factors that determine the rate, the lender, the qualification you're going to get. One of the best places I go to see just kind of a good average Freddie Mac interest rate is mortgagenewsdaily.com. They got really good news articles on there. The rate's kind of right at the top, where I think other websites like Bankrate, they're kind of a lead generating company. They're trying to gather leads and sell your information to a mortgage company or something like that, or a car loan company or credit card company. So there's a lot more advertisements, I think, on Bankrate. where I like Mortgage News Daily. It's a little bit quicker. It's a little less, it's more newsy, I guess is the word. I don't know if that's a word, but there's more news articles there and kind of more information that's out there. And it really gives you a true snapshot of more of the average rate that people are getting. Now you might see a billboard, you might see a advertisement in the mail or something on a website. And it's amazing how often that is simply the best rate that's out there. And we're talking 800 credit scores, 40% down, 10% debt ratio, owner occupied, rate and term. So you got to know that that's not the rate everybody's going to get. But if you want to know the rate you're actually going to get, check out my website at ryanbolton.com. I'd love to earn your business. Love talking with you about this stuff. I am the mortgage nerd. Check us out, and I'd love to earn your business to help you with any type of loan.
This has been the Clear to Close podcast. Please submit your comments, questions, and topics for future episodes to cleartoclosepod@gmail.com. That's clear the number 2, closepod@gmail.com or ryanbolton.com. Please like, follow, and share. And until next time, this is the Clear to Close podcast. The views expressed in this podcast do not necessarily reflect those of Patriot Home Mortgage, Equal Housing Lender, NMLS number 299717. This has been a production from a podcast studio.